Yesterday, more people searched "Did the stock market crash?" than on almost any other single day this year, which tells you something important, and it is not what you think. The panic was real. The understanding was thin. Here is the actual number that matters. A single session decline only qualifies as a technical crash under one specific threshold, and yesterday's move may or may not have crossed it. So before you touch your portfolio, before you call your broker, before you do anything, you need to know exactly what category of event you are dealing with, because the historical playbook changes completely depending on the answer. Let us establish the vocabulary first, because the financial media has an incentive to blur these lines, and your net worth depends on keeping them sharp. A market correction is a decline of 10% or more from a recent peak. They happen roughly once every 16 months on the S&P 500, historically speaking. A bear market is a sustained decline of 20% or more. A crash, the word everyone reached for yesterday, is a specific phenomenon. A sudden, severe single-session or multi-session drop, typically 7 to 10% or greater in a 24 to 48-hour window, often accompanied by a VIX spike above 30 and a breakdown in correlations across asset classes. Now apply that to yesterday. If the S&P 500 dropped between 1 and 3%, that is a bad day. Uncomfortable, but statistically unremarkable. The index averages roughly 50 days per year, with moves greater than 1% in either direction. If it dropped 4 to 6%, you are looking at a significant risk-off event, likely triggered by a macro catalyst, and historical data suggests you are still in correction territory rather than crash territory. If it dropped more than 7%, the conversation changes fundamentally. The reason this precision matters is not semantic. It is because your response strategy, whether you rebalance, whether you add to positions, whether you raise cash, should be calibrated to the actual severity of the event. Treating a 2% down day like Black Monday 1987 is how retail investors destroy returns by selling at exactly the wrong moment. The actionable insight here: before reacting, measure the move precisely and classify it. Emotion scales with headlines. Math does not. Every sharp market move has a surface-level story and a structural story. The media covers the surface. We are going to go one layer deeper. The surface story you likely heard involves some combination of weak economic data, Federal Reserve commentary, geopolitical tension, or a major earnings miss from a high-weight index component. All of those can be real catalysts. But here's what actually determines whether a single bad data print becomes a one-day event or the beginning of a multi-week unwind. First, credit markets. When equities sell off hard, watch investment-grade and high-yield credit spreads. If spreads are widening significantly alongside the equity drawdown, institutional money is pricing in real economic deterioration, not just sentiment. If spreads are stable or barely moving, the equity sell-off is likely technical. Stop-loss cascades, options hedging flows, or forced deleveraging by a specific category of player, like a volatility targeting fund. Second, the dollar and treasury relationship. A flight to safety that pushes both treasuries and the dollar higher simultaneously is a different animal than a sell-off where treasuries also fall. The latter suggests something is wrong with the sovereign risk picture, which is a far more serious signal. Third, breadth. A market decline where 80% or more of stocks are falling together indicates systemic selling pressure. A decline driven by a handful of mega-cap names that have outsized index weight can look catastrophic on the headline number, while the average stock barely moves. As of this recording, none of these secondary indicators are pointing to a structural breakdown in credit or sovereign markets. But that assessment requires daily monitoring, not weekly. The actionable takeaway? Read the credit market alongside the equity market. The bond market is larger, smarter, and less emotional than equities. It tells you when to take the noise seriously. Here is where the data gets genuinely useful. And this is not financial advice. Markets are not deterministic, and every cycle has unique characteristics. But pattern recognition across decades of market history is one of the most underused edges available to individual investors. Let us look at significant single-session drawdowns of 2% or more on the S&P 500 going back to 1980. There have been hundreds of them. The median return in the 30 days following such a decline is approximately flat to slightly positive, roughly 0.4%. The 60-day median return is approximately 1.8%. The 90-day median return is approximately 4.1%. That is not a call to buy the dip blindly. That is calibration tool. Now look specifically at the events that did not recover. That became the beginning of sustained bear markets. 2000, 2008, 2022. What did they have in common? In each case, the initial sharp decline was accompanied by deteriorating earnings revisions, tightening credit conditions, and forward guidance cuts from corporate management. The single-session move was a symptom, not the disease. The question to ask right now is not, should I panic? The question is, are earnings estimates being revised downward by analysts with genuine visibility into corporate revenue? Are bank lending standards tightening? Is corporate guidance turning cautious in aggregate? If the answers are no, no, and no, history says the sell-off is buyable, or at minimum ignorable, depending on your time horizon. If the answers are yes, then yesterday was not the crash. It was the warning shot. Check the FactSet earnings, revision data. It is published weekly and is one of the cleanest leading indicators available to non-institutional investors. That is the number that will tell you whether yesterday was a comma in a bull market or the opening sentence of something worse. So, did the stock market crash yesterday? Technically, probably not. But the fear was real, and real fear always contains signal worth extracting. You now know how to classify the move, read the secondary indicators that matter, and use 40 years of post-sell-off data to calibrate your response instead of your emotions. The next question, and the next video, is this. What does the current earnings cycle actually tell us about where we are in the broader market regime? Subscribe so you do not miss it.